Okay, let's talk a little bit about employer-sponsored retirement plans. Um, Now, contributions to retirement plans are tax deferred. And tax deferred means that the income tax will be paid at a later date. It doesn't mean tax free, but it will be paid at a later date. Now, why is this important? Here's just a little graph that shows someone puts in about $15,000 or $50,000 at year one, and it grows. So, this lighter colored area here is the value of taxable investment. So what that means is that as the amounts in this account grow through interest and dividends and capital gains, that income tax is paid each year on those taxable amounts. And you can see at the end of year 20, there will be $210,128 in there. If this account had been deferred, you can invest it in exactly the same stuff, but you do not pay tax as you go. So you leave more money in there, and that growth also is available to grow some more. And so you can see that at the end of year 20, the after this deferred account that has deferred tax, even after you take it out and pay the tax on it, you're still going to end up with $277,811. So tax deferred, it can be very powerful. Employer-sponsored retirement plans, the most common types are 401ks and 403bs. Now, employees can elect to be part of employer-sponsored retirement plans. The contributions of the employees are called elective deferrals. You're not required to participate in this, but of course you should. Often there will also be an employer contribution to a retirement account, usually they'll match some portion of what you put in. Now, both elective deferrals and employer contributions are excluded from current income. So, yay. If you contribute to these, the income that your gross income will be decreased. So here you have $20,000 in wages. This person elected to have $1,000 of it deferred and put into an employer retirement plan. So $19,000 will be included in gross income for the year. The $1,000 contribution will not be included in gross income. It's tax deferred. The income tax will be paid on the $1,000 when it's withdrawn, not tax-free, but tax deferred. Social Security and Medicare tax will be withheld based on the entire $20,000. So payroll taxes on the contribution, they're not tax deferred. Okay, example. Cheryl's employer has a 401k plan with a 25% employer match. She contributes $1,000. Her employer contributes another $250. Let's talk about plan distributions when you get ready to take the money out. This is taxed at ordinary income tax rates, even if it grew due to increases in capital gain items like stocks. When you take that money out, it's going to be taxed as ordinary income. But when you take it out, it will not be subject to payroll taxes. Now, if you take it out before age 59 and a half, there will be a pretty hefty penalty. You'll pay 10% plus the income tax on it. Cheryl is now 60. She decides to take a $3,000 distribution from the account. The $3,000 is now included in her income. It's taxed at ordinary rates, not subject to payroll taxes. There's a good reason why Cheryl waited till age 60 to make the withdrawal, because there's a 10% early withdrawal penalty for withdrawals before age 59 and a half. If she'd taken a distribution at age 59 and a quarter, her penalty would have been $300. So you're just throwing away good money. You need to have a really good reason to take money out of there to take it out before age 59 and a half. So do take advantage of employer-sponsored plans. At a minimum, contribute to get the maximum employer matching amount. Wait until after age 59 and a half to take withdrawals from retirement accounts. Do not withdraw amounts to pay off credit cards. Do not withdraw early, in other words, to finance an education. Now, there are some exceptions to this rule, which you can look up on the IRS website. There are also employer-sponsored plans that are considered Roth 401ks and Roth 403bs. So these are also a type of IRA plan, but they differ from regular old 401ks and 403bs because there is no tax deduction for contributions in these Roth plans. But the upside is distributions, when you take the money out, are tax-free if the account's been open for 5 years, and again, if the distribution is made after age 59 and a half or due to disability or death. And in this case, the growth will be tax-free, not tax-deferred. So, for example, the $20,000 will be included in gross income. The $1,000 contribution to the Roth will be included in gross income. It's not tax deferred, so the whole $20,000 will be included in gross income. However, down the road when you withdraw it, no tax will be paid on the $1,000, and no tax will be paid on the earnings from the $1,000. Social Security and Medicare tax will be withheld based on the entire $20,000. Payroll taxes on the contribution, they're not tax deferred. So for Roth earnings, they are never taxed if the account has been held over 5 years and the account holder is at least 59 and a half. So this is really usually a much better deal for people to contribute to Roths rather than to traditional IRAs or to employer plans that are 401ks, 403bs. So if you as an employee have an option between taking the non-Roth or the Roth is usually the way to go. Okay, let's talk about stock options. Here's the basics. An employer grants or gives an employee the right to buy a company stock at a certain price called the exercise or strike price. All right, now they grant this. Some of the vocabulary here you just need to get used to. They grant the employee the right to buy, and the employee doesn't get this stock for free. They're going to have to pay for it at a certain price, and that's called the exercise or the strike price. Now, this right is called a stock option because the employee has the option or choice to buy the stock or not. So the employee, they're not given the stock for free. They're going to have to buy it. So why should an employer grant an option to an employee? After all, an employee or anybody, you can buy stock in a publicly traded company at any time. Well, because stock options try to give the employee a more favorable price at which to buy stock than simply buying the stock at its fair market value on the stock market. So if or when the employee uses the option to buy a company stock, we say the employee has exercised the option. So again, a vocabulary you just need to get used to, that they've exercised the option. The employee buys the stock at the exercise or strike price. They don't buy the stock at the fair market value per the stock market. So, there wouldn't be much value in the option if they just paid the fair market value anyway. Okay, there's 3 important dates when we deal with stock options. The grant date, when the option is granted. The exercise date, when the option is exercised and the stock is bought by the employee. So when the employee exercises the option, that just means that they are buying the stock at the strike price. And the third date is the sales date, when the stock is sold by the employee. Now there's 2 types of stock options that we're going to talk about. Non-qualified stock option, a stock option that not meeting requirements to receive favorable tax treatment. We have incentive stock options, a stock option meeting the requirements to receive favorable tax treatment. To get these 2 favorable tax treatments, 2 of the requirements are that the option must be exercisable within 10 years of the grant date, and the exercise price of the option must not be less than the fair market value of the stock at the grant date. So there you go. Okay, so before we get into the taxation of these stock options, let's review ordinary versus capital gains income tax rates. The book also refers to ordinary income tax rates as the regular income tax rates, and these are these rates that we have looked at before, as opposed to long-term capital gains rates. Now remember, you can have capital gains that are short-term, and if they're short-term, then these rates do not apply. Ordinary income tax rates do apply. We're going to make a quick review of what we mean by basis. So this is an example from Chapter 4. The basis is the amount paid for the stock when paid for with after-tax dollars. So Carl doesn't pay tax on the basis because it's already been taxed. And so we have this principle of basis recovery. You get your basis back tax-free. Here is a chart for our non-qualified stock option, an ISO comparison. Okay, and you can see there's the 3 dates given. We're going to talk first about incentive stock options. These are qualified stock options that get favorable tax treatment. You can see at the grant date, no income taxes. At the exercise date, no income taxes. You may have an alternative minimum tax preference item, but we'll talk about that later in the course. At the sales date, you do have income taxes. And you can see here, if you look at this, you have 2 ifs. So we have 2 possibilities. If the stock was held for 2 years from the date of grant and 1 year from the date of exercise, then the gain is long-term capital gain. If the holding period is not met, the gain from the difference between the fair market value and the strike price is treated as ordinary W-2 income. So let's go through just an example. There's an incentive stock option. The option is exercised and the holding requirement for a long-term capital gain is met. So grant date, June 20, 2014. Samantha was granted an incentive stock option, 100 shares at $10 per share. And the $10 equaled the fair market value on the grant date. As we know, no income tax consequences. She exercised or bought the stock on February 20th, 2015. So Samantha exercises the option. At that time, the fair market value equaled $14 per share, and we have no income tax consequences. So you can see the value of this option. She only had to pay $10 for a stock that was worth $14. Then the third date we have is a sales date, July 25th, 2016. Samantha sells her shares for $1,700. So she has long-term capital gain of $700. Now, proceeds $1,700. Her basis is $1,000, so we have a gain of $700. Where did that basis come from? It was the amount she paid for the stock when she exercised it. She exercised the option on February 20, 2015 for 100 shares at $10 per share. Now, I'm telling you, of course, it was long-term capital gain, but what you need to do is look at this chart. If the stock was held for 2 years from the date of grant and 1 year from the date of exercise, then it's long-term capital gain. And she did hold it 2 years from the date of grant or 1 year from the date of exercise. So, long-term capital gain. That's good. Now here is an example where the holding requirement is not met. Same numbers, same example, but look at the sales date. She sold it 5 days after she exercised it. So she will not receive long-term capital gain treatment. Look at the chart. If the holding period is not met, the gain from the difference between the fair market value and the strike price is treated as ordinary W-2 income. So she has $700 of gain. She still received $1,700. She still paid $1,000. However, she didn't hold it long enough. And so it's not taxed as capital gain. It's taxed as ordinary income. And not only ordinary income, it's taxed as W-2 income, which means she's not only going to pay income tax on it, but she has to pay Social Security and Medicare tax on it also. So here's a summary of the ISO tax treatment. Gain is taxed at the latest possible date, the sales date. The gain is taxed at long-term capital gains rate or ordinary rates, plus the Social Security and Medicare tax withholding, depending on whether the holding period requirements are met. So you can see how important it is to meet those holding period requirements. So make sure clients with ISOs are aware of the holding requirements for long-term capital gain treatment. Now, it is not unusual for clients to just forego this long-term capital gain treatment and to take the income, sell the stock quickly and take the income as W-2 income. That's very common. Now, reasons why clients may not be willing to meet the holding requirements. One, they have an urgent need for cash, or two, they fear that the stock price will fall if they wait to sell, which isn't really unreasonable. So you'll see this a lot, that people are not willing to wait and get the long-term capital gain treatment. Okay, now let's talk about the non-qualified stock options. You can see that there's tax consequences at the grant date, possibly, uh, tax consequences at the exercise date, and tax consequences at the sales date. So here we have the same situation, except this is a non-qualified stock option. The grant date, Endora was granted a non-qualified stock option, $100 per share at $10 strike price per share. Now, look here on your chart. If the strike price is greater than the fair market value, you have no income tax consequence, which is the case here, and this is usually the case. So in this example, there's no ordinary income on the grant date because the strike price is greater than or equal to the fair market value on the grant date. She exercises it when the fair market value is $14 per share, and at that point, look on the chart, she has ordinary W-2 income to the extent that the fair market value exceeds the exercise price. And so she's going to have ordinary income, W-2 income, equal to $400, the difference between the strike price and the exercise price for all the 100 shares. And again, this is W-2 income, so she's going to have to pay Social Security and Medicare tax on it. Then the sales date, she sells it for $17 a share, and the gains are going to be taxed at capital gains rates. Now, let's look at what happens on the sales date. She has the proceeds of $1,700. Her basis in this case is $1,400. Why? She had to pay $1,000, not it says $10,000, but $1,000 when she bought it. And she also had to recognize W-2 income of $400. Even though she didn't get that $400, she has to put that on her tax return. So she has basically paid for these with taxable income of $400. This gives her a gain on the sales date of $300. This is going to be taxed at long-term capital gains. And how do you know? Because she bought them on February 20th, 2015, and she held them for more than a year and a day. Now notice that this basis for non-qualified stock options is always going to be the fair market value on the exercise date. And also notice if the stock isn't held for a year and a day from the exercise date, the gain is short-term capital gain. It will be taxed at ordinary rates, but no Social Security and Medicare taxes withheld because in this case, it'll be capital gain and not W-2 income. So look down here in the non-qualified stock options in your chart. At the sales date, you're going to have either long-term or short-term capital gain or loss, depending on the holding period. Something, though, you need to notice if it's that for these non-qualified stock options, at the sales date, the gain calculated at that time was $300, but the total gain was $700. You had proceeds of $700. They actually paid $1,000. I've got another $10,000 on there. $400 was taxed as W-2 income. $300 was taxed at long-term capital gains rate. And again, remember, if the capital gains rate holding period wasn't met, the $300 would be taxed at ordinary rates. So here's a summary of non-qualified stock options tax treatment. Some income could be included as early as the grant date if the strike price is less than the fair market value on the date of grant. The difference between the fair market value on the exercise date and the strike price will be taxed as W-2 income, including Social Security and Medicare. The difference between the fair market value on the exercise date and the sales price will be taxed at long-term capital gains rates or at ordinary income rates based on the holding period. So for ISOs, if the holding period's met, the entire gain will be taxed as long-term capital gain. If it's not met, the entire gain will be taxed as W-2 income, including Social Security and Medicare tax. For non-qualified stock options, the difference between the strike price and the fair market value will be taxed as W-2 income, including Social Security and Medicare tax. And the remainder of the gain will be taxed as long-term capital gain or at ordinary rates. So be sure clients with your non-qualified stock options meet those long-term capital gain holding periods to get favorable tax treatment, unless they just really want cash in hand today.